And what we've seen so far this year is all a company has to do is just whisper the word NFT. And then their share price flies for no reason whatsoever. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of November 22nd, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. Well, that wasn't the most fun week that we've had in a hot minute. The NASDAQ composite was up, the S&P was kind of up, but mostly flat. The Dow was down, and the Russell was down bigly. Oh boy, my small caps be bleeding again. I'm kind of noticing a common trend here. Small caps just seem to be taking hit after hit after hit this year. And actually, if you go back and you look at a lot of even the mid caps for the stock market, it's very, very top heavy right now, where the big companies just keep getting bigger and everybody else is kind of having a flat year or just slightly up. It's getting really, really tough. Big news, I do have a DD video this week. If you're not following me on Twitter, I did tweet out about it. I found a very exciting company. Well, actually, the company itself is pretty boring, but the financials, the metrics, and everything else about it is very, very exciting. And oh boy, I do think I might be saying the short squeeze word in the video. As much as it pains me, it is actually a legitimate possibility with this company the way that it is set up right now. Let's get started with the news. I think the unfurling Rivian and Ford saga is so compelling right now. We know that Rivian IPO, the valuation was obscene, and since then it started to come back down. Nature's beginning to heal. But it's still way, way, way overpriced. Now, there were a couple of interesting articles from Ford this week, and I just want to hit the headlines and talk about how they tie together. Ford plans to increase its production capacity of electric vehicles to 600,000 units globally by 2023, and CEO Jim Farley expects that this would make the company the second largest US-based producer of EVs behind Tesla. Now, it's not completely sure if that's going to happen because GM plans to sell 1 million EVs globally by 2025. So it just depends on the speed at which Ford and GM each accomplish this feat that they've set out to do. Okay, so that's headline number one. Headline number two, Ford and Rivian cancel plans to jointly develop an EV. They're no longer planning to co-develop an EV. They initially announced development of a joint vehicle when Ford invested $500 million in Rivian in 2019. Ford still has its 12% stake in Rivian, which at the company's IPO last week reached a value of more than $10 billion, and we know that the price has gone up since IPO. Headline number three, Ford and Rivian's breakup, sour grapes, growing confidence, or something else. And here's something I didn't actually know about their relationship. Even before the split where they're not going to co-develop a vehicle, Ford in 2020 canceled a program which would have seen one of its vehicles built on the Rivian frame, and this past spring, Ford gave up its Rivian board seat as Rivian's IPO approached. Okay, so I'm going to tell you what I think is happening right here. When I read that article from Barron's about Ford giving up its board seat, which I didn't know about, and that could actually be some SEC regulations, but whatever. The fact that Ford backed off from Rivian, and it was said to be like a mutually exclusive thing, but I don't think there's any way in the world that Ford backing off from Rivian is mutually exclusive. I'm pretty sure that's a unilateral decision by Ford, and even though Rivian technically has a higher market cap than Ford, we all know which is the more established brand, which one actually produces, you know, a respectable amount of vehicles and has revenue. What I think happened here is that Ford realized its EVs were doing so well. The Ford Mustang EV has been drawing comparisons to the Teslas. The Ford Lightning EV F-150 has surpassed 100,000 in pre-orders. That's actually, I think, more pre-orders than Rivian has for its R1T, but don't quote me on that one. I think you have to double check the math. I'm pretty sure I'm right though. So at the time when Ford was investing in Rivian, it didn't know how its own EV plans were going to pan out. But since then, it's become wildly successful, and it doesn't even need Rivian at this point anymore. What I think is going to be happening here is that Ford is going to be selling out of its full 12% stake in Rivian as soon as the share lockup ends. And this is going to absolutely crash the Rivian share price as the market is flooded with Ford's 12% stake. And then Ford is going to pivot and use that money from selling its Rivian stake, obviously for operational expenses, but also to accelerate its own EV production capabilities. This is some big brain stuff from Ford, and this is also super cutthroat. Now, a lot of this is speculation on my part, but you gotta see the pieces definitely line up here, especially with the amount that Jim Farley has said he wants to invest in the EV sector. They're talking about throwing like $11.2 billion at this. Their stake in Rivian is worth like $12 billion right now. So you could kind of see where the numbers line up a little bit. I am really excited about Ford for this one. I think Ford is going to pop, and I think this is ultimately going to lead to Rivian falling back down to a more reasonable valuation. Again, if we look at the share price for Rivian, we ended up hitting a high point of 179.47, and right now we're sitting at about 127.15 after market, and the low point on IPO day was 95.20. You could have gotten in pre-IPO at $78 a share, but I mean, nobody on the publicly traded market even sniffed anything close to $78 a share. Because of the share lockup rules, I think that $78 a share is going to be setting a strong floor for the share price until the share lockup expires, and then people are able to sell their shares from IPO, and then just the floor is going to drop out on Rivian. I really believe so. Ford, on the other hand, has had a really consistent march upward since about April at $11 a share. It ended up hitting a high a couple days back of 20.51, and currently we're sitting at about 19.34 after hours. If you're not aware, Ford has a ton of shares. The free float of Ford is 3.92 billion shares, which I just realized the free float is higher than the shares outstanding. How does that work out? I'm not sure actually how that works out. That might be a bug here on Webull. I'll have to look into that later. Next news story, Alibaba shares drop 11% as it slashes its guidance and earnings plunge on China's economic slowdown. Alibaba's been a victim of China's crackdown on its domestic technology industry, which has seen a slew of new regulations brought in from antitrust data protection. Expectations were low coming into the fiscal second quarter earnings report as a result, and analysts expected it to be one of the most challenging quarters ever for the e-commerce giant, and it inevitably was. EPS was much lower than expected, 11.2 yuan versus 12.36 yuan estimated, and this represents a 38% year-on-year decline. They had the double whammy there. They also slashed their revenue guidance for the current fiscal year, previously expecting to bring in 930 billion yuan, which would have been a 29.5% year-on-year growth, but now it expects growth to be between 20 and 23% year-on-year. So it slashed that down to 6.5% plus. Now, China is facing a lot of stiff competition domestically. JD.com is growing, and Pinduoduo. If you haven't looked at Pinduoduo, check out their revenue gains quarter on quarter. Every quarter now, it seems like Pinduoduo is getting a 100% revenue boost. That's nuts. So Alibaba has a lot of stiff competition in China. This drop-off is somewhat expected because a lot of the analysts were thinking the quarter was going to be tough. But I think it's important to put everything into perspective. Alibaba was forecasting 29.5% year-on-year growth, which is nuts, honestly. But they're cutting that guidance down to 20 to 23% year-on-year growth. Stop and think about that. Even at the low end, 20% year-on-year growth for a company of Alibaba's size is crazy. That is insane growth still. And I still think that Alibaba is a good company in a good spot, and it's one of the few companies in China that I would be interested in investing in. That being said, I still do not have a position in Alibaba, but it's right up there. Alibaba, Baidu, and the more I read about Pinduoduo, the more I like Pinduoduo. Take a quick look at Alibaba's charts. After the earnings report, the share price cratered back down to where we were at the low point at the beginning of October. So we ended up hitting a high again of 182. We went from 138 to 182, and we're back down at 140.08. That's not much progress right there. Next news story, Nvidia data center sales grew 55% on demand for artificial intelligence chips. Nvidia stock has been on a big run over the past year with shares up more than 123% year to date. The company also issued a bullish forecast for revenue in the current quarter ending in January. Earnings were $1.17 adjusted versus $1.11 expected, and this is up 60% year on year. Revenue is $7.1 billion versus $6.82 expected, which is up 50% year on year. The company made significant gains in its data centers, where cloud providers and big enterprises are turning to the kind of graphics processors made by Nvidia for artificial intelligence applications. Crest said customers are using the chips for tasks such as understanding human speech and crunching data to offer customer recommendations. A lot of the AI usage right now for commercial purposes is going towards customer forecasting and customer pull, where you're trying to hit a new target group of customers that you didn't previously anticipate, and data mining through AI is being used for these purposes. And Nvidia chips are at the forefront of anything AI related. And seeing Nvidia rise the way it has and the data centers become so successful, it really reminds you that this is a multi-vectored business, and it's not getting left behind in the dust by AMD, which we've seen with these meteoric rises lately. Technically, Nvidia is still leading AMD, but both of them are wonderful semiconductor companies. They're both succeeding, and actually the one getting left in the dust is Intel. So here's to hoping that Intel Foundry and the big investment does turn Intel's fortunes around. Take a quick look at the Nvidia charts. After the earnings report, the gains were stellar. We ended up having a plus 8% the next day and a plus 4% the day after that. So a 12% gain on an already pricey stock with a high market cap, coming in close to $1 trillion. I really think Nvidia is going to be the next company that does hit that $1 trillion market cap. I know, bold claim there, Walrus, coming in at 824 billion. We're really not that far away, but I can definitely see, especially with their data center growth, them crossing that 1T mark. Next up, two quick notes about Evergrande. Evergrande default is highly likely, S&P says. No shit. I mean, what? Yeah. We still believe an Evergrande default is highly likely, S&P Global Ratings analyst said in a report Thursday. The firm has lost the capacity to sell new homes, which means its main business model is effectively defunct. And also, Evergrande chiefs luxury assets in focus as his company scrambles to pay down debts. Its founders freeing up funds from luxury assets, including art, calligraphy, and 3 high-end homes. Chinese authorities have told Evergrande chairman Hui Kaiyan to use some of his personal wealth to pay bondholders, 2 separate people, with knowledge of the matter, told Reuters last month. So 2 big takeaways here. Number 1, the S&P ratings analyst is like way behind the curve. I think everybody knew Evergrande defaulted when they failed to pay after the grace period ended on their bond payments. Like, yeah, no shit, they defaulted. That's the definition of default, failure to pay. And then we also have the Chinese government forcing the CEO of Evergrande to sell off his private assets, his personal wealth, to start paying back bondholders. And this is, I'm just imagining like a whole "the power of Christ compels you" situation going on in China. You gotta remember, his personal wealth, I think last I saw it was around $13 billion. Evergrande owes $30 billion in debt, the world's most indebted corporation. So even if he completely liquidates and sells all of his assets, there's no chance that this even makes a dent in Evergrande paying back its debt. I mean, I'm not saying he shouldn't do that. He absolutely should do that. He's responsible for a lot of the decisions that were made to put Evergrande into this position, but it's still not going to much matter in the long run. Just waiting for this whole ticking time bomb of the Evergrande situation to blow up. And now, sidebar, we have like other ticking time bombs in the world. I was just reading that the China-Taiwan situation is actually deteriorating by the day, and Russia and Ukraine are starting to do things like the Ukraine Defense Agency just said that Russia could be invading as soon as January. I mean, the world, what are you doing? I just want peace so that my investments can do well. Is that so much to ask? Next news story, Trump-linked SPAC stock slides after Senator Warren calls for SEC investigation. All right, guys, set the timer. Another SEC investigation was called on some sort of stock market impropriety. When do we think this is going to be addressed? Well, judging by the GameStop situation, never. DWAC is planning to merge with a firm called the Trump Media and Technology Group, with the former president serving as chairman of the resulting company. Warren pointed to a media report that the representatives of DWAC and Trump's new company discussed a merger in May. They may have committed securities violations by not disclosing those talks, Warren asserted, and the Trump Media and Technology Group did not respond to a request for comment. Now, I'm not saying DWAC did nothing wrong here. I haven't really read enough into the situation, but when you look at the players involved, former President Trump and Senator Elizabeth Warren, who were not exactly on the friendliest of terms during Trump's presidency, you have to wonder if this isn't at least a little bit politically motivated and not necessarily anything more improper than any other SPAC has done. The DWAC chart is, well, whack, I guess. Do people still say that? Does anybody still say whack? So once the SPAC was listed, obviously it was trading flat right around NAV, as most SPACs do. And then we had our announcement. We ran all the way up to 175, which is much higher than most SPACs run. And since then we've fallen off. Currently we're sitting at 51.43 after hours. So DWAC is still probably overvalued. Probably. I don't really know how to value a SPAC in this situation, but as far as impropriety goes, I don't know. SPACs are already pretty fast and loose, and I'm not really sure if there was actually impropriety there, or if this is just politically motivated. Either way, the SEC's slow to deal with anything, so probably nothing comes of this. Next news story, record selling by insiders is setting up stocks for a big fall, says Contrarian Investor. It's Contrarian Investor Day, everybody. All bears deserve their say too, even though we are in a bull market forever and ever and ever and ever and ever. Eventually the bears will be right. What's the saying? Bears have correctly forecasted 2,000 of the last 2 stock market crashes. Keep going, guys. You'll get there eventually. This contrarian voice belongs to Morgan Stanley, who's telling his clients to resist buying US stocks. People are really underappreciating the degree of risk they're taking because now that we have, especially for the really big mega cap names, even greater overvaluation than we've had before, the downside risk is extremely high. We've had all-time records of insider selling, meaning that the top executives, the people that are the most experienced investors in the world, have pretty much been spending all year getting rid of their stake and in some cases unloading huge amounts of shares that they've accumulated for decades. So I think that the people that have the most knowledge are the most worried about a drop, and the people that have the least experience in some cases, maybe just started trading in the past year or so, consistently are the most aggressive and the most optimistic about what's going to happen. But history has shown us that when you have that big of a difference in opinion from the most experienced to the least experienced people, that the most experienced ones always come out on top. I think obviously that there is definitely some credence to what Kaplan is saying here because, yeah, we're really, really high. I talk about the valuation every week. And in fact, I just had a YouTube comment where somebody was criticizing me for not being able to find value opportunities every single week. And I responded to them, I try, I'm looking, it's just getting harder and harder and harder to find value opportunities in this market with some of these obscene valuations. It's not like I don't want to find the next BNGO or something. It's that it's really freaking hard right now to find something that's just not blown the F up. So do I think the stock market is going to crash? Yeah, probably eventually. Once the Fed starts raising their interest rates and it starts to hit a certain threshold, I do think the market is going to be pulling back really, really sharply. Historically, we've seen that Fed rates have inverse relationships with stock valuations. As the Fed hikes its rates, the stock valuations typically fall off. Also, there's a lot of geopolitical things happening in the world right now. Like I mentioned, China, Taiwan, Russia, Ukraine, these are issues that could really, really threaten to destabilize international trade, depending on how far they progress. Next news story, Peloton shares rise after company nets $1.07 billion in a discounted stock sale. Peloton said Tuesday it plans to sell roughly 23.9 million shares of its Class A common stock at a public offering price of $46. This announcement comes as the connected fitness equipment maker is looking for ways to shore up cash amid slowing momentum for its products. Once again, let me highlight this. Shares rise after company nets $1 billion in discounted stock sale. This is a discounted stock sale. Discounted. That means the company sold the stock at a lower price than asking market price, and the share price on the company went up. This was a dilutionary event happening at a discount, and the share price went up. What? Here's the earnings for Peloton. We had that really big drop off. This is the day of the share sale announcement. There was a 15% gain in share price overall on the day before falling back down. Currently, we're sitting at $47, which is still above the share sale offering of $46. We're living in a clown world. I don't know how else to say it. Last week, if you remember, I did talk about Oatly. Oatly hit by challenging Q3 earnings, COVID effects, and the stock is down 18%. The company missed revenue consensus and reported more supply chain disruptions. They announced a loss per share of 7 cents on revenue of $171 million. Analysts polled by investing.com anticipated a per share loss of 9 cents on revenue of $185.89 million. So revenue was a miss, but the EPS was a slight gain, even though it was still negative. Looking ahead for the full year, the company expects revenue to exceed $635 million, which is below the $694 million consensus, and that's probably the big problem there. The global supply chain interruptions are affecting Oatly. They went on talking about this at length in the earnings report. But the big thing, I think, was the drop in the guidance for the entire year. That was a substantial drop. That was like almost a 10% drop in their guidance for the year, which for a company that just recently IPO'd, that's not a good look. And I talked about this last week. I don't hate Oatly. I love the product. But we're sitting around a market cap of $6 billion for a company that makes plant milk. That's kind of a lot of money for a single product. And I know somebody might come in the chat and be like, oh, well, they make ice cream too. Shut up. Ice cream is just frozen solid milk. It's the same product in a different state. Get out of here. The valuation's still dumb, and even though the shares did rise towards the end of the week after the initial drop off, I still think this is going to crater and floor somewhere around $7 or $8. And if that does happen, then I would be looking at taking a position in Oatly because of the general trend towards plant-based foods. So here's the drop on earnings. That day yielded almost a 20% drop. The next day recovered about 9%, and the week kind of flattened off. Currently, we're sitting exiting after hours at about 10.18. A few short months ago, Oatly did hit a high of $29 a share. Oh, how the mighty have fallen. I did see one super funny comment online about this. It was, "There's no moat in oat." And that there's the truth of the entire situation. Next news story, Target Corporation reports their third quarter earnings. Their sales grew 12.7% on top of a 20.7% growth last year. All of their merchandise categories delivered double-digit comparable sales growth. Their results were stellar, and this actually showed kind of a bit of an inequality to me because I've been following a lot of the retail earnings reports, and Target has been able to use its cash flow to mitigate the price increases, and they're very strongly committed to giving their customers the lowest possible price. And this, as a result, has actually substantially cut into their margin, their business margin. And you guys know retail already operates on a very, very thin margin. So this kind of cut into the future guidance for Target a little bit, but it also showed how they were able to shore up a lot of the supply chain issues without passing the burden onto the customer as much as some smaller retailers have. This is just kind of another case of the big get a little bit stronger, the big get bigger, and the small guys get pushed down. And it's really, really indicative of how competitive the retail industry is. Also, if you want to have a laugh, go to their earnings transcript, search the word supply chain. Supply chain appears not 5, 10, 20 times now. 32 times in this earnings report, they went ahead and referenced supply chain. One pretty cool note right here at the beginning from John Mulligan. On our supply chain team, the focus is on moving the right amount of inventory to the right place at the right time. In our stores, which fulfill more than 95% of our total sales, the team focuses on delivering a great guest experience across hundreds of millions of guest transactions every quarter. But in the fourth quarter, when we handle the largest volumes of the year, everything moves faster, making the need for detailed planning and precise execution even greater. That's why every year we construct our plans with the fourth quarter in mind so we can remove distractions and roadblocks in advance to the holiday peak. Some of those roadblocks obviously were the supply chain interruptions. What a lot of the retailers, Walmart and Target included, were reporting this year is that the Christmas sales, the retail spending happened much earlier in the year. So they were actually prepared to handle that retail spending on all the additional demand from a supply chain perspective, and they managed to get through it all right. And this sounds like Target managed the situation very, very well, despite the increased costs brought about by supply chain problems such as increased shipping costs. Now, Target's share price did fall off, but we had an XD day right before the earnings. So a lot of this might have been because of the XD. They do have a 1.44% dividend yield. So part of this drop is from the XD, part of this is from the earnings, the future guidance not being as stellar as expected, but really this drop off isn't going to be any more extreme than this. I cannot imagine Target keeps falling, and I think we just resume the upward trend sometime this week. Now, speaking of that supply chain crisis, Bloomberg just reported the US supply chain crisis is already easing. Progress is still slow and too many boats are waiting at the ports, but many problems have at least stopped getting worse. Global average ocean freights for 40-foot containers have now declined for 8 straight weeks. Meanwhile, the number of containers lingering for longer than 9 days at the Port of Los Angeles has dropped by about a third since the hub announced a plan in October to start fining ocean carriers for excessive dwell times. I read another article that had a hilarious take on this, saying that the excessive dwell times that the ships were being fined for were actually alleviated by the ships just moving out into international waters. So now people can't see the ships lined up at the Port of Los Angeles because the ships are simply anchored in international waters. Oh, okay. So this is one of those situations where the problem still exists, but we're just going to go ahead and sweep it under the rug, out of sight, out of mind, and pretend that everything is peachy. The spot price falling for 8 straight weeks. Yeah, that sounds really, really great, but also look at it this way. All of the holiday goods were already shipped into America for the holiday spending season, for the retail spending season. Shipping is a cyclical industry, so this is the normal time of year for shipping rates to fall off because, hey, all the holiday shipping's already completed. The boom is done. So now's the time when the shipping rates do get lower. So this article, even though it's saying that the supply chain problems are getting resolved, you know, this is why it's in Bloomberg opinion and not on the regular Bloomberg website, because this really is just an opinion. This whole piece is just a farce. Let's take a look at the upcoming earnings for the week. Keep in mind, we do have a shortened week. Thursday is the Thanksgiving holiday. Some interesting ones this week going through. Obviously, a lot of people are probably buying puts on Zoom because every other pandemic company has crashed since the pandemic has been winding down and people have been getting out of their houses. We've got Dick's Sporting Goods. Some of the other sporting good companies have been reporting really great earnings. Best Buy, I would expect to just blow the roof off of everything because the early holiday spending is going to be influencing Best Buy. We have John Deere. John Deere's workers have been on strike for seemingly the entire quarter. I know that's an exaggeration, but there's no possible way John Deere meets any of its earnings expectations. The stock price is going to fall after earnings, most likely. I can't imagine it goes up, really. But the only question is going to be, how much does it fall? Are the analysts and the people that look at their earnings report going to be like, well, I expected much worse, or are they going to be like, yeah, no, this is more catastrophic than we ever imagined? So what's the actual take going to be here on John Deere? I don't really know. I think it's going to be surprising to the downside, because when we looked at the stock price for John Deere a little while ago, the chart was actually holding remarkably steady, considering they just didn't have workers. We've got a lot of clothing retailers. We've got Urban Outfitters, American Eagle, Abercrombie and Fitch, Nordstrom, Gap, Burlington. Now, all of these clothing retailers should be reporting pretty strong earnings because of the holiday expenditures being earlier than usual. But I don't really know how the supply chain issues are going to be affecting a lot of these companies, because other than Nordstrom, these are all much smaller companies. And whereas Walmart and Target can kind of mitigate the margin increases using their free cash flow, these smaller retailers tend to not be able to do that. So I think if one of these retailers does surprise on their earnings, it's going to be totally unexpected, and we might actually see one of these just pop off like 15% gain. I really think the reality here is that a lot of the earnings from these retailers are going to be disappointing, and it's going to be because of the margin issues. Either that, or their quarter revenue was good, but their forward guidance is going to be bad because of the margin from the supply chain increases. Now, continuing on that same thread, Macy's had its earnings report last week. They beat on their earnings in Q3. They were actually able to raise their fiscal year 2021 guidance, and I think Macy's is obviously a stronger player than somebody like Abercrombie and Fitch, but their shares soared 21.2%. And I looked at this Macy's earnings report and I was thinking, damn, how is that even possible? 21.2%. There's gotta be something else here. So I kept looking. Macy's launches its first ever NFT series in celebration of the 95th annual Macy's Thanksgiving Day Parade. The world famous holiday event celebrates its 95th anniversary with a special drop of 9,500 free NFT artworks featuring iconic balloons from its rich legacy in support of Make-A-Wish. Oh, that's it. That's why the price jumped 21%. It wasn't because of the earnings, it was because Macy's is releasing an NFT. And what we've seen so far this year is all a company has to do is just whisper the word NFT. And then their share price flies for no reason whatsoever. Sure enough, here's Macy's share price once the NFT was announced. We had a 21.17% gain, followed by a 7% pullback the next day. This whole situation reminds me of the Family Guy episode where Lois is running for mayor and she just keeps saying the word 9/11 and everybody just starts clapping like crazy. I feel like that's what companies can do right now. Just say NFT and people are like, yeah, share price appreciation, valuable company, it's tech, blah. Yeah. Anyway, I think Macy's does tie in, and if Macy's can beat their forward guidance, realistically, I think some of these smaller retailers can possibly do the same if they had enough free cash flow to manage the tight margins. All right, everybody, that's it for me today. Like I said, I am going to be releasing a DD video this week on top of my new Theta Wheel video. Also, I did get a haircut, so you don't have any more horrible hair walrus to look at. As always, if you enjoyed the video today and you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please like the video, subscribe to the channel, and if you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. Good luck investing, and I'll see you next time.